thanks for stopping by my market report. I am Mike, and a little bit about this report is we discuss what's going on with mortgage rates on a daily basis. We do touch a little bit on stocks as they do can correlate because, as you may or may not know, mortgage rates are basically derived from mortgage-backed securities and not the 10-year Treasury. They do kind of go sometimes in the same line together, but not always, and that's why it's important to be able to follow what mortgage-backed securities. Now, a little bit about myself is I'm a lender and I work with National Lender. So if you got questions about mortgage rates or mortgage programs, refinances, or even that of purchases, needing a pre-approval to purchase, I'm your guy. You can certainly reach out. Be more than happy to talk a little bit about how we can help you guys out or answer questions you may have. So please feel free to reach out. So to begin with the report, we'll start with the economic report. We're going to go a little bit out of order because, to be quite honest, this I don't like how they have it laid out. So we'll start out with the PCE on a month over month. So here's the month over month, which is the personal consumption expenditure. The PCE is actually the Fed's favorite gauge for inflation, and what they look at is the core, which is when you exclude food and energy from the equation, and that's really what they'll look at. We'll touch on that here in a second, but let's first start with the headline number of the PCE. And in January it rose 0.3% and forecast and came in at 0.2% increase here. Now its year over year did rise from 1.5% to 1.6%. A lot of this, of course, is we've been seeing higher oil prices or gas prices. We're seeing food continue to rise in cost. Now, when we strip out that food and energy, of course, like I just said, we had the food and we had the core PCE. And this is really what the Fed will look at in terms of when he's talking about inflation being between 2 and 2.5%. That's what he's looking at year over year. So let's start with the month over month with the core PCE. So in January it went up 0.3%. Forecast was calling for 0.1% increase and came in at forecast for the month of February. Its year over year it came in at from January at 1.5%. Forecast was calling for it to remain unchanged. However, that one dipped a little bit lower at 1.4%. Now we also got personal income for the month of February. We had 10% increase in the month of January. However, in February it was a different result. The forecast calling for a drop of 7.3% and it dropped 7.1%. So pretty close to that of that. Now on the other hand, from consumer or personal income, we got spending. So in January it rose 2.4%. However, forecast calling for a 0.7% drop, and it dropped a little bit more at 1%. Last but not least, we also got the consumer sentiment. This kind of is a survey given by the University of Michigan. It touches on how the consumers are feeling out there. And a lot of times we'll get like two of these, but this will be the final reading. So the initial report back in February, it came in at 83. However, forecasts were calling for a slight uptick to 83.6 and exceeded that to 84.9. So people are feeling a lot better in March. Maybe it has to do with the stimulus checks coming out. I don't know, but in any case, it was a pretty big jump by 1.4, 1.9, almost 2 points right there. Let's jump ahead and take a look here at the headline news. Stocks are up. We're kind of taking its cue again from what we've been knowing. Now, we've had some good data out of Europe, so that kind of helped, and that did affect the bond market early on, which we'll see here in a moment. But they're also having lockdowns over there, so they're kind of looking at the global level on the economies, vaccinations, and such. We have month end and quarter end with the higher yields. We're seeing, of course, repositioning of these large hedge fund companies, rebalancing and repositioning their funds. So now with yields spiking, they're pretty much getting out of more of the high tech, which is high growth areas, into more like financial, maybe even buying more treasuries or bonds on top of that to be able to sustain and create with the higher yields and get a better return on their money. And looking at energy, you're looking at those sectors as being very popular. So we're looking at that. We also had, it's kind of spiking the news, was Biden wanted to double his intake for the first 100 days, going from 100 million to 200 million vaccinations. So we'll see if that happens. But in any case, the headline news, of course, makes investors a bit more excited because that means more people they feel that we get that herd mentality out there, get people out there and open up the economy that much more rapidly and try to get back into the normal. So again, let's move on to the mortgage-backed series, see what mortgage rates are doing today. We started the morning way down. This was due to, again, overnight it started off with the European trade with the good economic news data. We started off lower here. So in East Coast, we probably had worse pricing as a result. It dropped, as you can see, dramatically. We did go up. We were up and then pulled back a little bit. Currently we're down about 3 basis points. But here on the West Coast, you may have come in with a little bit about the same price that we saw yesterday. It may be a little bit worse, depending on the time on the West Coast here that the people came out with. But we also came in negative yesterday. So those who didn't reprice for the worst yesterday, it really wasn't enough for it to be repriced worse. It was probably about 6 basis points, but it's different from where we were earlier on in the day, and then continued with today. So some lenders may come in a little worse pricing today as a result of this. Hopefully that makes sense. I didn't make that clear. But with this continuing to improve, we may see some improvement. But again, we'll have to wait and see. We're getting a little pressure from yields, which you'll see here in a bit. We broke above that yesterday, back above that line there. We started up much higher, like closer to 1.67 range. But right now we're down to about 1.64 range right now. So we'll have to see if we can get that to drop a little bit more. This may kind of go into a sideways pattern here. We'll have to wait and see, but we're trying to get this below the 1.62 to help us out here. Meanwhile, the 25-day moving average is rising higher, and again, we'll have that as a double floor support for this 1.62 if it doesn't break below it sooner than later. All right, folks. Again, I'm going to go on the limb here more or less and say you're going to probably see pricing a little bit worse today, but potentially if we can get a rebound in mortgage-backed securities, maybe we can get an improvement and get to where we were yesterday, pricing to be unchanged. But right now, I'd simply say most lenders probably have a little worse pricing today from the late decline in the day yesterday, and then followed up with today's drop. All right, folks, have a great rest of your day. Thanks so much for watching. Enjoy your weekend, and we'll see you on Monday's report. Bye-bye.